Hi there. Thanks for tuning in. Today we're going to do an analysis and valuation of Teleperformance. Ticker symbol TLPFF or TLPFY for the ADR. So, let's go. Now, what's Teleperformance? Teleperformance is essentially an outsourcing leader for customer and citizen experience. Essentially, if you need something done in customer care, in phone and tech support services, but now even in debt collection services and some other tangential services that Teleperformance has, then they have a service for you. And actually, they operate in basically the whole wide world, right? They operate in 91 countries, in 170 markets, in 300 plus languages. They have a bunch of employees who work from home and they work for a lot of businesses. So they're a pretty big company and they're working in a lot of places with a whole lot of people, right? And here's a list from their Wikipedia article of just other specialized services that they do, mainly through companies they have acquired over time. For example, they have collection services, they have translation and localization services, they even do visa services, recruitment process outsourcing services, health management business services. They're doing a whole lot in this larger theme of outsourcing for other companies, right? So this is fantastic. They are in a lot of different businesses. They have a little bit of offerings for everyone, it seems. So that's cool to see. We'll see the numbers later. Now that they mentioned people, though, because they do have a lot of employees, it's actually really cool, and they stress this a lot, that Teleperformance is actually ranked as a great place to work, generally, in a lot of the geographies they're in, and in a lot of workplace review sites. They're ranked pretty highly there, which is cool. Global outsourcing companies, well, they don't always have the best reputation. And it's cool that Teleperformance really cares about maintaining their reputation as a great place to work. Now, I haven't talked personally with any employee of Teleperformance. This is something that maybe as a fuller research would be important to do, right? If you're doing that sort of scuttlebutt method. But as of right now, it's cool that they emphasize that so much and they're always trying to rank pretty highly as a great place to work. It's something that's refreshing to see. I feel like I read a lot of investor presentations and a lot of annual reports, and I really don't see a lot of companies stress that. Teleperformance does, and that's pretty refreshing. Now, we'll see that the mix of their clients is in all sorts of sectors. They're in healthcare, financial services, media, governments, travel, hospitality, telecom, technology. That's really cool. That also means that they're not exposed to downturns in a single industry, because they're covering all these other industries, anyways. It's fantastic. And they can also help and benefit from the growth of all these different industries that they're participating in. So it's awesome because they're diversified in their clients and they're diversified in their geographies. That reduces risk. Now, they also have a dividend that has been growing over the years. Their payout ratio, they seem to like to keep it at that 35% level roughly over the years, but it's growing. It's going to keep growing, it seems, and it's a about 2.5% yield right now, which isn't the biggest one, but with the growth, it's something that's given back to you, and you're benefiting from that, right? They also have some interesting finances here where their revenue has been an incredibly steady grower. They haven't really had a negative year in terms of revenue ever. And some of that does come from government help due to the global situation in 2020. But even before that, their growth has been absolutely stellar in terms of revenue. Same for net profit, which only really 2020 was a down year for net profit. Same for free cash flow, which hasn't necessarily been perfect, but has been pretty good. And their capital expenditures, actually, if you look over here, have been trending downwards, which is cool. They're getting some of that under control. And their net debt also, it seems to have basically shot up for a lot of acquisitions they've done, but they're also trying to sort of work that their way down on some debt, right? And their net debt to EBITDA, which is a good number to keep in mind, especially because we're this company to liquidate. We want a low net debt to EBITDA ratio because Otherwise, the shareholders won't get anything back, right? First, they're going to pay all their creditors and all their debtors, and then the shareholders, if there's anything left, would get anything back. So we want to see a low net debt to EBITDA number. That's good to see. So they also have all this revenue growing in different segments, right? So for example, in North America, in Latin America, in Europe, they have all the revenue diversified throughout these sectors, and it's growing through all of these sectors. In Europe, it's a little bit difficult because there was some contracts related to the global situation in 2020. However, overall, it's growing, and overall it's expected to keep growing, right? And they outline in their annual report their financial objectives, which they want a revenue growth above 7% essentially, and for 2025 they want revenue above 10 billion euros, and that's really cool. And they're also trying to just expand the EBITDA margins from 15.7% to 16%, so that's great to see, honestly. So, and they're saying that their acquisitions will contribute 1 billion to 2 billion in additional revenue by 2025. Cool. So they're trying their best to integrate those acquisitions and also grow them as well. They're not acquiring anyone to just sort of consolidate. They're actually trying to grow and get into different sectors that then they can optimize, right? So also, let's talk about debt. Now, most of their debt is actually fixed in their interest rate, a little bit variable, and the average cost of gross debt is 1.88%, which is actually really, really low. So they're decently well protected against increase in interest rates, which is great to see. A lot of companies can be harmed by increasing interest rates, especially if they have a lot of debt. Teleperformance does not have a negligible amount of debt, but at such a low cost, and since most of it is fixed, they're actually in a pretty great position here. So that sort of brings me peace in terms of the risk that debt can bring, or high levels of debt can bring, right? Free cash flow also, they seem to be having growing, healthy free cash flow. Here they also include in their free cash flow calculation the loans that they repay, the lease payments and whatnot. My calculation, the numbers I'll be taking will be from Seeking Alpha, simply for simplicity's sake. So those will be converted into US dollars and won't include things such as debt repayments. And I can't calculate how much debt they're going to repay in the future, so I'm going to be using a little bit more simplified numbers. But it's great that they always include this calculation in their presentations and in their annual reports. I love to see companies emphasize free cash flow, right? Now, with these numbers, I can make a discounted cash flow model using free cash flow to equity. What I'm going to do is I'm going to assign them a 4% revenue growth rate from 2023 to 2026. Super simple like that. And I'm going to give them a free cash flow to revenue ratio of 12%. So 12% of the revenue gets turned into free cash flow. That's what they had for 2020, 2021, and 2022. So let's just say it keeps steady like that, right? It may be more if they manage to trim down some capital expenditures. It may be less if capital expenditures go up. But I'm just going to go with that assumption. 4% revenue growth rate, which is less than what they said would happen for next year, which was about a 7% revenue growth rate. So I'm going to be conservative here. Now, I'm going to have a required rate of return of 11% per year, which is 1% more than the S&P 500 would give you on a long-term average, right? 1% per year more is a lot, right? Perpetual growth rate, I'm going to give them 2%. So just 2% for perpetuity. That's going to be part of this terminal value over here. And then divided by the total number of shares, that gives us a fair value of 217.47 US dollars. However, if we account for the net debt that they have, their fair value post-debt would be $169.40. So this is cool, but we have to compare it to the current stock price. So where's the stock price right now? Interesting. So here's the 5-year chart for Teleperformance, and they've gone up 5% in the last 5 years. So you'll see that if you held it for the last 5 years, you're probably not super happy with your investment. But it also shows that there's good times to buy it, bad times to buy it, maybe good times to sell, you know? So if you bought it around here before 2020, you were probably really happy if you sold in mid 2021, maybe even early 2022. However, if you held it all this time, well, maybe you're not that happy right now. However, the price right now of around $168 is pretty much in line with the fair value I'm getting, right? And it's interesting because this company has not been anywhere near a range where I would even consider buying it. I would not buy it at $400. I would not even buy it at $300. $200? Maybe if the growth projections were better, or maybe if they had less shares or a higher dividend, maybe. But now that it's at this near 52-week low, this is something I would seriously consider because we're talking about a company that is fairly insulated from risk and has pretty great results. So Teleperformance is at a pretty good point right now. And we have to talk about what drives value for it. So one thing is that if we're focusing on risk first, then their strong diversification across industries and geographic regions gives them amazing shelling towards any risk, They will not be as affected by downturns in particular industries, in particular geographies, as other companies will. They have a growing dividend, so that's cool because at least we get that return. They have a flat share count. They don't have buybacks, they barely do, but they don't have dilution either. Or if they do, it is going to be tiny. So that's great to see as well. They have solid growth in dividends and free cash flow. They also have solid growth in revenue. So that is great because you can participate in that growth. You'll be getting the dividend plus the growth in the cash that the company gets that they can decide to reinvest however they want, grow the dividend, buy back more shares, grow the company even further, acquire more companies that will hopefully bring even further returns later on. However, there is a risk in the euro and other forex rates because they mainly operate out of Europe. Well, those currencies that they're going to be getting, if they lose value against the dollar, that's going to be something that you should keep in mind. And actually, I think it is somewhat part of why Teleperformance has been underperforming this past year, these past 2 years, is also because of currency exchange rates. So that's something to keep in mind. I'm not an expert in currency exchange rates, I'll admit, but that is something that you have to always keep in mind and that you can see maybe be a wrench that can be put into the value that you're getting from here. However, I would still say that with amazing performance and with amazing results, that can be trivialized a little bit, right? So I must ask, is this a great company at a fair price? Because we're pretty close, according to my calculation, which albeit is a little bit conservative, to the price that it is at right now. And this seems to be a great company, right? So this just depends on your philosophy. Is this something where you're looking at companies that are very, very undervalued and you potentially want to make a ton per year because they're so undervalued that once the market recognizes it, it's going to grow exponentially? Or are you also happy with a great company at a fair price? And then that would give you about the returns you can expect. Maybe not doubling every year, but pretty consistent returns every year. It's maybe a little bit more boring of a style of investing, but Teleperformance is a company that wasn't at any level where I would have considered buying it recently, and now it is. So maybe it is a great company at a fair price, but that is for you to determine with how it fits with your investment goals and your portfolio. Now, if you found this video useful, I hope you can like this video and subscribe to the channel because there will be plenty more videos like these. And if you have any questions about the analysis, feel free to comment down below. I'll respond to it, no problem. So thank you so much for watching, and I hope you have a great rest of your day.